Hi, welcome back. It's been one scary week, right? In fact, it's the kind of week where you forget everything you've ever learned about investing. You want to throw it all to the winds and go with your gut. And I'll tell you something. Whenever I've gone with my gut, nothing good seems to happen. Because let's face it, a week like this, when markets are down and down substantially, the fear factor rises, right? And people react one of three ways. Some sell and run for the hills. They say, this is the end. Some are paralyzed. They don't know what to do. And some essentially are brave enough to be contrarians. They buy into the selling. I've been tempted by all three camps at different points of every day this week. And I have to constantly go back to a playbook, a sequence that I go through every time there's a market crisis, because if I don't, I know that my animal spirit, so to speak, will rise to the surface and I will do dumb things. So here's the first step when you're facing a market crisis. Gauge the damage, see what's happened. Because it's so easy in the midst of a market crisis to lose all perspective. You're so caught up in the mood of the day, what's happening that day, that you can't step back and look at the big picture. So here's what I started with. We had a bad week, a really bad week in the US. The S&P 500 was down a lot. But before you panic, let's put the numbers in perspective. If you look at the last week, the S&P 500 lost 8.54%. By the last week, I mean from last Friday through yesterday. I'm not counting today, which is Friday. So it's basically Friday through Thursday, a 5-day trading sequence. The S&P 500 lost 8.5%. That's mind-bogglingly bad. But before you freak out, think back to if you bought stocks last Thursday, you're sunk, right? You have no salvation. But if you bought stocks on January 1st of 2018, which is only about 6 weeks ago, you'd have lost only 3.5%. A loss, but not a catastrophic loss. And in fact, if you bought stocks a year ago, you're ahead 13.25%. If you bought stocks 10 years ago, remember, this is the February before the market crisis, you'd have gone through a crisis far worse than this one. And over the 10 years, you would have accumulated a return of 90.48%. And this is not even including dividends. I'm not suggesting last week hasn't been bad. I'm saying it's time we step back and ask, how bad has it been looking at the bigger picture? We've had a very good run with stocks. We really have nothing to complain about. Now, if you start slicing and dicing across sectors, the pain spread across sectors in the US. The worst sector was the energy sector, where a drop in oil prices added to the pain, and it was by far the worst performing sector. But the pain, as you can see, cuts across sectors. Utilities did less badly than the rest of the sectors, which is not uncommon. It's the safest. And in fact, you can get a version of what we call beta, by looking at how bad the week was for the sector relative to the market. And that's in the third column. But again, if you step back and look at the bigger picture, it starts to look a lot better. The energy sector is still done badly if you look at the last year. But if you look across most sectors, you've made a lot of money over the last year. The last week has been a bad week. Looking across geographies, I decided to look for the worst performing and the best performing indices over the last week. And guess what? Almost every index in the world felt some pain. In fact, of the Wall Street Journal International Indices, which is not a comprehensive list, only one index, the Colombo Index, showed a positive return. Every other index showed negative returns. The US and Argentina had the worst weeks, but you can see that many big Asian markets, Japan, China, also had bad weeks. On the other side of the spectrum, the indices that did the best last week were some small Asian markets, Indonesia, Malaysia, Thailand, Philippines. I'm not sure what to make of it, but the pain was spread across geographies, but you can see that the pain was far worse in North America and the large Asian markets than it was in the smaller Asian markets, and Europe fell somewhere in the middle. Finally, I decided to take a look at what's been fingered as the culprit, because if you ask most people why the stock market is down this week, they point the finger at T-bond rates going up. And there is an element of truth to it. So let's look at how the bond market did during the week. So I took a look at the T-bill and the T-bond rate. They both went up, but not by large percentages. But that's a little misleading. The T-bond rate increased by 0.09%, which is hardly any increase at all. But before you decide this was a good week for T-bonds, remember in a week like last week when stocks are collapsing, usually T-bond rates drop a lot. They don't go up. So the very fact that they went up suggests that there's some truth to the story, that there's an interest rate component to this crisis. I also looked at AAA, triple B, and triple C corporate bonds to see how those markets did during the crisis. And the rates on those bonds went up, and they went up by more than they did in the T-bond. In other words, default spreads went up, which is consistent with an increased risk aversion story. In fact, one of the interesting stories here again is to look back over the last year rather than the last week. And here's what we've seen. We've seen T-bond rates go up, but more importantly, we've seen T-bill rates go up a lot more. The yield curve has become a lot flatter over the last year, and that might be contributing a little bit to this crisis. So now what? Step 2 in this process, you got to look for reasons, but don't get carried away. Sometimes a cigar is just a cigar. Sometimes we try to put rational explanations on things that cannot be explained. There are 3 possible explanations for any large crisis like this, where markets drop significantly over a short period. The first is the panic response, that people have just panicked and they've sold. And the panic response doesn't need a reason. You just start, the momentum shifts, people start selling. And the nature of a panic response is that it will get reversed. So the most benign explanation for a big drop in the market is it's just panic, because once the panic passes, the drop in the market will also subside. The second possible explanation is a shift in fundamentals. Just like an individual company's value is driven by cash flows, growth, and risk, the value of an entire index or market is driven by cash flows, growth, and risk for the entire market. Perhaps something significant has happened to one of those. An example would be that if you got news or an announcement that cash flows were going to decrease by 30% or 25% over the next year, or it could take the form of some kind of catastrophic event, you will see values dropping because the fundamentals have shifted. The nature of a fundamental reason for market collapses is that reason will not go away. In fact, the market will stay down and the focus will be on that fundamental, whether it's cash flows, growth, or risk. There's a third component to why sometimes you see big market movements in short periods, and that is investors reprice risk. You see, what are you talking about? There's a price for risk in markets, right? In the equity market, we call it the equity risk premium. In the bond market, we call it default spreads. That price of risk is set by demand and supply. If for whatever reason people wake up and decide to reprice risk, they decide they've priced risk too low and push up the risk premium, stock prices and bond prices will have to go down. Now, in most crises, all 3 reasons come into play. The question is, which one is the dominant one? Because that dominant one is going to determine how long the crisis will last and how quickly you will bounce back. So let me take a look at this crisis and try to diagnose the crisis. I think this crisis was triggered by a fundamental. If you go back to last Friday, the day that this crisis started, we started with an unemployment report that came out before the market opened. And on the face of it, it contained good news. 200,000 new jobs, wages had gone up. But the wages going up by 2.9% was uncommon because while we've had a string of jobs reports that report more jobs in the US, wages have been pretty restrained. There hasn't been much growth. So now you see a jump in wages, which is good for workers. So in a sense, that's good news for them. But that also triggered fears of inflation and higher rates. And that seemed to be the starting point for this crisis, is the fear of higher inflation and higher interest rates. That fear led to a repricing of risk. How do I know? As you know, I compute a forward-looking risk premium called an implied equity risk premium based on the level of the index. I computed that every day from last Friday through yesterday. And what you will see on this page is how that equity risk premium has shifted over 5 days. Over 5 days, the implied equity risk premium in the US has gone from 4.78% to 5.22%. That's a 0.44% increase over a period of 5 days. That's a pretty large surge over a short period in a developed market. So there's been a repricing of risk as investors, perhaps spooked by inflation, are looking and saying, maybe we've underestimated the risk in the market. And there's, of course, the panic factor that kicked in. The panic factor is driven by people looking at stocks falling, being afraid they will fall more, and selling. Now, before you blame millennials and their robo-advisors for this selling, which is what I've seen some reporters do, I'd like to point out to you that millennials have been remarkably restrained during this crisis. It's the usual culprits. You know who they are? Professional money managers who are most likely to panic and sell, and they're contributing to the panic selling. So at this stage, you're saying, what do? I fall back on an old device. I go back to fundamentals. And three questions I think we need to answer to decide what to do next. The first is we have to decide where interest rates are going. To answer this question, I think you have to stop looking at the Fed. Jerome Powell is not going to be your savior, and think about what drives interest rates over time. What drives interest rates are expectations of inflation and expectations of real growth. A couple of weeks ago, I pointed this out as the weakest link in markets, that T-bond rates were much lower than intrinsic T-bond rates computed by adding inflation and real growth. I think interest rates are going to go up if the economy stays strong and inflation starts to go up. In fact, not even to high levels, to levels that they were pre-2008. So I think interest rates are going to go up, and that's the first judgment you need to make. To what number? Is it going to be 3%, 3.5%, 4%, 4.5%? That's going to make a big difference. Second, you have to decide for yourself what a reasonable equity risk premium is. I showed you what my implied premium was on February 8th of 2018. It was 5.22%. The question you're asking is that a high number? Is that a low number? Because if it's too low, then there's more pain to come, because the equity risk premium will have to continue to go up and stock prices will have to go down. You're saying, how will I make that judgment? Well, I can give you some history. Over the last 57 years, if you look at implied equity risk premium, that number has been about 4.1%. If you go back 20 years, it's 4.5%. If you go back 10 years, it's 5.5%. We're at 5.22%. We're right in the middle of the distribution. So if you trust history, then equity risk premiums are not too high or not too low. And finally, the question of when will the panic hit? I have no idea. If you're a trader, this becomes your basis for making money, because if you can tell how momentum shifts are happening, you can make a ton of money in the market, or you can get poor really fast. I am awful at projecting momentum. I'm not even going to try, but as an investor, a long-term investor, I shouldn't even be trying. In fact, this is a good point to actually bring these all together and talk about how this would play out as an intrinsic valuation of the S&P 500. Just as a what if. Remember, I'm not a market timer. I'm not going to try to time the market for you. Let's assume you took the growth in earnings for the S&P 500 that analysts have projected. But 7.2, 7.3% is a reasonable number. And you assume that T-bond rates would go to 3% and equity risk premiums of 5% are reasonable. You know what? The market's exactly where it should be. I'm not saying this should mean that markets are fairly valued, but I'm saying your views about growth, earnings growth, risk-free rates, and equity risk premiums will determine what you think about markets today. In fact, take the spreadsheet that you can download. It's attached as a link to this particular YouTube video. Play with it. Put your numbers in, and if you have a chance, I've created a Google shared spreadsheet where you can go and enter your numbers, and you can tell me what your value for the index is. Let's do a crowd valuation of the index. Let's see what we get. Which brings me to the third step. As we go through all of this, we have to remind ourselves that we came to the markets to play a particular game. There's a philosophy. I firmly believe that to be a successful investor, you need an investment philosophy that reflects what you think about markets and what's right for you, what kind of person you are. So I've given you a bunch of choices here using my price value divergence. You could be a market timer, in which case you believe your strength is in timing markets. You can be a trader, in which you believe your strength is in calling price momentum and mood. So you use charts and technical analysis. You can be an investor, and you can either be a value investor where you think your source of advantage is valuing more mature companies, or a growth investor where you think you can value growth companies better. But there is a particular philosophy that you picked that was right for you. Don't forget that philosophy in the midst of a crisis, because you will be tempted. I will tell you what I think I am. I am an investor who believes in value. My definition of value is expansive enough that I can buy both value stocks and growth stocks. But that is what I believe in. I'm an awful market timer. I'm absolutely awful at it. And during the last week, I was tempted to be a market timer. In what sense? I was tempted to sell. Why? Because the market was going down. I was tempted to buy because I thought it had gone down too much. I have to remember that I'm not a market timer. And that's tough to do during moments of crisis. So here are my final suggestions. As you look back over the last week, you will probably have regrets. You know what I'm talking about? You say, what if I'd only sold all my stocks last Thursday? Well, you didn't, and you don't have a time machine. There is no point regretting past decisions made or not made. In fact, I would argue that not only is it pointless, it could actually be damaging for future decisions. Let go. What's happened has happened. On Monday morning, when you come in, take whatever philosophy you have and say, how would I apply it in this market? So I'll tell you what I'm doing right now. I am looking at a list of companies that I've always wanted to own. That these are companies I love, but they were trading at prices that were too high for me. I'll give you a few examples. Amazon. I always want to own Amazon. I've owned it 4 times. I've bought it 4 times. I've sold it 4 times. I haven't held it in a while. I'd love to hold Amazon. Netflix, Tesla. So I'm going to go down that list and revalue every company. Maybe this market correction will bring some of them onto my buy list. Amazon, not quite, but some of the others maybe. I'm also revaluing every company I have in my existing portfolio. Why? Because some of them might be sells, and this will be a good time to sell. Not because everybody else is selling or the market is down, but because these stocks are overvalued. What this will do is it'll force me to focus on what works for me. And in the process, it'll keep me so busy that I can't worry about what everybody else is doing. I hope you found this useful, and thank you for listening.